Marksman Capital presents.
Good day, folks. It's been a long time since I've recorded one of these videos, and I've come across to this wonderful business. And after being 17 years in the markets, you know it's a wonderful business if you found one. And I've been using the top, the strictest fundamental qualifications to narrow down to the top 0.7%. That means 60 stocks out of 8,000 US listed stock in the market. We want to really capitalize on the top 0.7%, but not necessarily owning them all at a time. So you can always own maybe about 15 to 20 stocks at a time. So we can always rotate, right? And there will always be a time to rotate and balancing the stock portfolio. So it's been a long time. So for the past couple of months, I've not been feeling quite well. I just had a surgery and removed my tubes yesterday, my breathing tubes. So, but this one of this company just got me woke up, and I think it's really, it's really worthwhile to share this stock right now. It's in biotech and pharmaceutical industry, and when we talk about biotech and pharmaceutical, many of us here thinks about volatility, but I'm here to say this is different. From saying that this is volatile, but if you look at the fundamentals and the technicals of it, it has a low beta, right? Low beta stock, and it doesn't have really huge volatility up and downside. And I would say this is more defensive because when you talk about biotech and pharmaceutical companies, if any single individual companies, if we tend to invest in, the biggest risk is that if the drug fails, then the price could actually collapse, maybe 90% all the way from top. All right, so I've seen those happening in biotech, but this is the company where they actually supply diagnostic equipments, laboratory equipments to all the industry, pharmaceutical and biotech manufacturers out there. So they are the guys who sell the shovel. All right, so let's move on. All right, so here's the disclaimer. All right, just maybe pause a while and read the disclaimer. Let's move on. So now, if we're looking to own one of these biotech companies, a huge macro trend, so there's a lot of upside and it's not slowing down anytime. So here's a source that says there's a projection within 2022 to 2026. There's a 9 to 12% CAGR. And so the bottom line here is that it's expected demand to double in 6 years. All right, there are more spendings within 6 years, even government spending. Consumers are going to demand more of this, and this is really a growth driver, and it's pandemic proof. So, and it's also not just pandemic proof; it's actually pandemic boosted business. All right, so you can see the top major players that spread across this industry. They all are enjoying a great revenues growth over some years and moving forward to many years to come. So when we say macro trends or secular bull growth, it means that the trend will last for 10 years or more. There's still more upside to be going on the later part. So a bit of this business overview, and I would like to say that I am not too technical in scientific terms right here. So the main clause we want to read right up here is that the Thermo Fisher Scientific offers life sciences solutions, analytical instruments, specialty diagnostics, and laboratory products and service worldwide. So there's a lot. It goes to a point that it becomes pointless if I read all these special technical terms, unless you are the researcher or scientist, you might know a lot more on these products. But if I look at the fundamentals, it tells me that this is a wonderful business. I couldn't spread across widely and a lot deep, but we want to rely, what we want to do is we want to rely on the fundamentals here. And like in US stocks, the top 6%, 0.6% are the ones which gives us the highest potential, the best potential in the upside, the best chances, all right? So in short, I would like to say, don't go digging the gold in gold mines. You may or you may not find gold. So instead, sell the gold shovel. right? This is how this company is positioned. So they are providing the equipment and solution to biotech and pharmaceutical manufacturers. So the company was incorporated in 1956. So it's roughly about 60 over years, and based in Waltham, Massachusetts, in US, right? All right. So now right here, when we talk about the revenue streams, they are divided into 4 segments. I would say the main segment right here is laboratory products and services. They're 35%. They're generating about 32 billion in revenues. So 35% comes from laboratory products and services. And the second one comes from life sciences solutions, right? So then you have analytical instruments and specialty diagnostics. And I would say in this COVID pandemic, when it started, they are the first ones to be there to get the lab tests to be done, and substances. They provide substances to pharmaceutical companies so they can run diagnostics together, right? Or even by those companies themselves. And when we talk about the regions they serve, mainly they serve 53% in North America, 26% in Europe, 18% in Asia Pacific, and 3% the rest of the world. Right? So, well, right. So there you have it. Just in a nutshell. And well, this is the first step that I always look into companies to know if they are wonderful business. So we knew the macro trend, and if they're actually going in sync with the macro trend in parallel, right? So now I always look at the past 10 years, minimum the past 5 years, and the past 10 years it has been consistent. And if you look at the revenues, the cash flow, and the net income, it's going pretty well, right? So this is any business that you find this first step. If it passes this first step, it belongs to the top. I would say it belongs to the top 0.6% of the companies in US. So not many companies they do this. Like 90 over percent of the companies they don't do this. But if the companies they have this, the upside potential of your capital gains will be a lot more, right? So if you look at terms in percentage, and we can look at the 2020 and 21. We knew that this company, there's a huge jump in 2020 because of its pandemic boosted, and then they have to provide such an instant of all these equipments to worldwide, right? And of course, if you look in terms of percentage, the cash flow, operation and cash flow, and net income, it has jumped quite significantly. Of course, it has actually cooled down a little bit on year 2021. But of course, if you look into the annual report, they are increasing their R&D percentages, right? In terms of percentages, they are increasing to actually gain more advantages and innovation in this industry. So of course, in the first step also, I would like to see if the price trends are really steady, going up steadily. And these are the companies that I would like to buy the dips. Every time it dips, and then it will actually go higher in dips because it's a very predictable business, all right, in the long term. Now, what do we expect from the returns? So returns that, let's say over the years, the capital gains that we start from 2012 all the way to 2021. And you can see, say there's some good years, right? Great years in, let's say, right here about 2014. 2014, you have like 75%, of course, but we don't get that all the time. So what we did was we averaged out, we get about 33. We can expect about around 30% a year. Okay, and of course, great businesses, they have flat years or negative years in between, maybe 10 years, 2 or 3 times, but in this case, it's 1 time in 10 years, right? 2 or 3 times flat or down years. Then some great years, usually a year or 2 after that, there will be great gains. You can see that the year followed by a flat price action on the capital gains. The next year it gives you back around 35, right? Then the following years there are more, all right? So of course there are some fundamental reasons where they are growing they give you back around 45%. That's really crazy, astronomical results after 2009. So fundamental reasons. And if we look at the forecasted, and this is like the second step that I do in fundamental qualifications, and to table it down on the growth, projected growth, future projected growth. This is actually 3 years, and actually you can do projected growth in 5 years. Doesn't matter. This is from Simply Wall Street. I've tabled it down to, it gives us a double digit. As long as it gives us a double digit, it's all good. And yeah, I'm also expecting if this industry has a lot more upside, then they must reinvest more in the net income. So you can see there's a lot heated up during the pandemic. All right, heated up demand. They have to cool down a little bit before it starts to continue further up on the EPS. All right, so pretty good on this. Now, here's the picture where we look at the competitive mapping. I just picked a few big players. The top 6 companies control 30% of the market share. I would say yes, this industry is really fragmented, and it's hard for you to find someone like Microsoft who commands 70% market share, or Facebook or Google commands 80 or 90% of the market share in their own respective industries. But biotech, there are 200 over players in markets, and all of them are trying to outcompete one another. So I would say Danaher and Thermo Fisher, they're amongst the biggest in the revenues and market cap. The size of the bubble represents the market cap. You can see they're almost the same, around 200 over market cap in about 230 billion or 200 billion in market cap. Net margin, they're almost the same. Revenues, of course, Thermo Fisher commands the most in biotech, in the biotech industry. All right. So, like I said, if you are looking for a space in your portfolio to have a space in biotechnology and pharmaceutical, this is a company that we would consider in our watch list. And if we pick and down a few more stocks, Illumina, IQVIA, Agilent Technology, and Avantor. All right, those are notable ones, and they don't really come close. You can see there's a gap. All right, this just gives us an idea. There's a gap in the net margin and the market cap, and the biggest market cap tends to be the most invested companies, and this is where the most financial institutions they put these bets into this duopoly. All right, you can call it duopoly because they, in fundamentally perspective, we can see that they are very close to one another. All right, in this the same industry. All right, so we get to pick. If one of these, I mean, we can always spread the cost between these two, right? Or we can always invest in one of these companies. Right? Of course, we want to be in the best ones. Well, now again, if we look further on into the net margins, and if we look at the net margins bell curve or distribution curve, now they're skewed to the right-hand side. All right, and not necessarily mean that they always are on the most narrow, to the right-hand side here, but they are amongst the, if we are talking about the entire industry, they beat the rest of the 82% of the companies. So this is ranked a lot higher than the rest. All right, so now one thing is great, if we look at the ROE, is the capability of this company, how good they can make money based on the shareholders' equity or investment. If it is like 12%, it's good. So, and if it's above 15%, it's excellent or great. So at least it is trending upwards consistently. And this is for the past 5 years. It's showing really great results. And it's like since January 2019, it has surpassed 12 and going up to like 20.5%. So now it's March. So yeah, there's a lot more to see. So generally, yep, this is what I like to see in great businesses, and not many of them qualify 12, 15%, right? Like the top 1% of the companies. So, all right. So now this is also this is on the entire industry. Total global biotech drug sales from the past 10 years, I would say. So again, it gives us a picture that now it's actually, you see, there's a huge gap last year because it's pandemic driven. Right, it's pretty defensive, I would say. Well, this is what we want to keep safe. And when we compare the capital gains, Thermo Fisher in this year is still leading the pack, but you can see that Illumina is competing one of its segment. It's the genetic sequencing. That is one of the segment. But Thermo Fisher aims to be a one-stop solution. So they have been acquiring a lot of companies. They want to generate more revenues, but in comparison of revenues, if we rewind back a little bit between Illumina and Thermo Fisher, all right, I've also invested in Illumina. for the last 2 weeks. So it's still a huge gap at the moment. All right, but unless if Illumina takes on more segments, but it's more specialized. So I would say Illumina now it's about in terms of revenue, it's about 4.52 billion. All right, still not that huge yet. But of course, if you look at the price action, Illumina, because it's more concentrated or focused into one segment, it's quite volatile in the sense that sometimes it can outperform Thermo Fisher. And Thermo Fisher, it's very much similar to Microsoft price action. All right, it's as stable as that because I mean, if it's a great stock, why is less volatile? Because I mean, in times of uncertainty, people would like to stay in stocks that are more with certainty. All right. So the stocks that are not certain, they tend to be more volatile. All right. Okay. So of course, if we want to look at the terms of volatility, sometimes we can look at the beta. It is measured less than 1. Right. Beta is like a measurement of volatility. This is around 8.2. Sorry, 0.82. Right, below 1. So this is considered a very not volatile stock. And if we talk about volatile, then I'll give you an example like a Boeing. It can actually go up like a few 100%, and it goes down even a few 100%. Now, this is a stock that comes with less certainty. And if we look at in times of pandemic, it is not pandemic proof, and it's still revenues is still losing revenues, and profits is losing profits, cash flows like bleeding. So it's not going to be stable. So if you look at the terms of beta, and this stock is about 1.4, it's way above 1. So this is something that I would like to avoid in my portfolio. It was once a great business because it's duopoly, since it's only between this and Airbus majority. They're in many segments as well, aerospace and defense. But yeah, something that we want to avoid all in all. And what we like to have is something like Microsoft. This is pretty much close. Thermo Fisher reminds me of Microsoft, and Microsoft is one of these Wall Street darlings. Most people's portfolio would own this stock because the business is very predictable. It's also invested in across most secular bull growth, like even like social media, LinkedIn. It has been acquiring a lot of companies. If you buy Microsoft, you're buying quite a lot of companies, right? It's great cash flow generators as well. And of course, if you're looking in terms of beta, it's also below 1. And when we talk about defensive stocks like McDonald's, another example, it gives us the beta. This is way below 1, 0.61. Magnificent, right? Okay, so this is also pandemic-proof kind of stocks because, if it's pandemic, people still want to go and eat burgers. But this is in consumer staples, all right? Now, let's go on the kind of financials. And if we want to see if the debts are conservative and if they're doing well, we have more assets than liabilities. So if we look at the current ratio, it's way above 1. So this is 1.49. I would say it's great. All right. Then the debt to equity, this is above 50%. And to understand why, this is driven. They need more debts. This is driven because of global R&D on biotech demand has surged significantly to counter pandemic issues. So that needed to boost new findings. So as far as we can concern, right here, this industry has needed more spending to actually drive more growth in the future. So this is not really an issue. But of course, if I invest in companies, I would like to see conservative debts. Right? But this is only one metric, key metric. And further on, we want to see, we want to know if they can service their debts. So I've moved on to into the income statement. And if we look at the interest net expense of capitalized interest, all right, tracking 12 months, the latest debt record is about 536 million. But if you compare against their cash flow, they can pay this out easily. They have 9 billion in cash to pay 536 million debts. But how much is that debt? It's a small fraction of that of the entire business. This is basically sorry, I think I made a mistake in this calculation. It's about 6%. No, I correct it now, so apologize for that. Let's recalculate that again. Sorry, apologized. That 536 million divided by about 9.3 billion. So 9312 times 100. Right, so it's about 5.75%. Right, 5.75%. And right, let's go back. So I've corrected these numbers right here. So you can see that this is 5.75%, and the maximum that we could accept it's 30%. So this is below, and it's very conservative debt structure. Right? So it's just like how much like the threshold is 30%. Beyond 30%, most people would consider it a very very risky debt structure. All right. So this is structured well. Okay. So now in terms of if we look at the intrinsic value, and this is where value investors would swear by it. But of course, this stock you don't hear it all the time. It's not a household item, and for some truth behind, sometimes great businesses don't really go undervalued all the time. And if you look carefully into this, it has been trending above. Sometimes it goes below the intrinsic value, but 70% of the time is above the intrinsic value, and it's just hovering somewhere around there. Yeah, when we talk about intrinsic value, it's a guideline. There's no hard and fast rules on that. And right now, it's just touching right around the fair value. And this is just one source. And many different sources, they sometimes give you a slightly different number. It's a range that we're talking about. So that's basically it's just a guideline. All right. So most great stocks, businesses, they just hover around. They can be on top or slightly below around the fair value, all right, or the intrinsic value. So right now it's just 13% above the premium it's trading. And I will give you an example, and this is clearly Chicago Mercantile Exchange, CME Group. It's one of the duopoly in the exchanges. And if you look at the characteristic right here, it's sometimes you don't hear it a lot that it's in the media, but see 70% of the time it's hovering above the intrinsic value. But doesn't mean that it doesn't go up. All right. Fundamentally, this is also a great stock, great business. And if you look at Biomed, it's also one of the monopoly. It's also hovering closely above the fair value. So again, this is another great example to say that not all great businesses you can buy below intrinsic value all the time. All we have to do it's also to compare it with the technicals. If it touches, if it does some corrections, that we'll see how we handle it later. I'll just go briefly into that. So if you look at group focus on this intrinsic value of Thermo Fisher, right now it's hovering around 7.68 above the premium. And of course, if you look at simply Wall Street, it's about 0.7 overvalued. So it's just fairly valued at this moment. And Warren Buffett used to have a saying right here. It's far better to buy a wonderful company at fair price than a fair company at a wonderful price. So, well, from this wise man, of course, a lot of things might have happened in the past. It has happened in the past that he might have missed out some wonderful business at looking. You can't always look for great discounts, right, for such a wonderful business. So sometimes we can always allocate maybe some percentage, maybe about 30% now. Then later part, if it goes lower, another 30%, and if it goes even lower, another 30%. In stages, we can accumulate this stock. There are a few approaches we can do it. All right. So now, just to say, this recaps most of the things that we say. Now, of course, I can't be too technical in scientific terms. Again, it would be pointless if I mention it all. We can't even remember all of it. But if this is not a great business, why are the institutions owning 90% of the shares, right? So general public maybe 9.7%, right? So 90% are owned by the financial institutions, right? It's great evidence that this is a great business, right? If not, they won't be owning that much. So in terms of technical, I don't find there's a lot of deep retracement all the time, and consistently over the years that it has been trending upwards above the weekly moving averages. Most times it actually bounces off the 50 weekly moving averages. All right, you can see like in 2019, recent ones, 17%, and you have beginning and the mid of 2019, 11%. Then you have 2020 pandemic, it only retraces down to 26%. So when a stock is very defensive, it recovers very fast as well. Not many of these owners want to actually dump these stocks because they know this is a great business, and after that a huge bull run, then you have only around 18% correction. So there's not a lot of deep corrections, a shallow one. And recently I bought it over around here. All right, this is it has done about 23% correction, but of course I waited for this is what I like to call a bear trap. But of course it can always, because you can see that this ranging period can be around 1 year. Like this is like from last July, around the same price range to the next year July, and this can be 1 year. Right, this can be 1 year, sometimes 9 months to 1.5 years sometimes, but this one is like 9 months to a year. So now recently it's just not more than 3 months. It can always go up and come back and retest in one of the deeper moving averages before it starts to move up. Of course, it's a bit unrealistic for me to time to buy another one if it retraces down to 36%, but that's where I mark it as a significant support, because it has really bounced quite a number of times here. If it does come back here, right now I've accumulated about 50% at this point, but if it does come down here 36%, then yes, I'll be ready to accumulate more. All right, around there. So knowing that this is a wonderful business. So yeah, I guess again, I like to remind you that a beta, it's about 0.82, below 1, low beta, consistent gains, but not very deep retracement, very shallow retracement. And the recent candle, it's quite huge in green. But usually when you have a huge green candle right after the retracement, sometimes it gives us another chance to go in again, because there's a chance that the market manipulators, they would actually force the price lower, right, to actually shake out most of the retail traders before they allow the price to go up again. Right, that's the accumulation and distribution process, but that's one of it. So okay, I am glad that I will be able to share this this right after my recovery, and of course it'll take more weeks for me to recover. I now I feel that this would help you in some of these insights in this company. So happy trading and investing. Striker X here signing out. If you like this video, please hit the subscribe and like button, and also notification button if you like to get more of these videos. And we also have a Facebook group where we call Global Financial Markets Trading, and we will provide the link below in the description column.